Out with the old, in with the new Issues Watch podcast. Hello and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. The quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, well, I thought that 2023 was going to remain light, but no, the FASB decides to push out two pronouncements right at the very end of the year. So they're good pronouncements, not good, they're interesting pronouncements, and the second one's definitely going to relate to a lot of people. The first one might not at this point, but down the road it could. So the first one is intangibles, goodwill, and other crypto assets. Now everybody's sitting there saying, oh, crypto assets, what do I need to know about this before we don't have it? At this point, people don't, but you know that people are starting to get more and more involved in this. And this guidance that came out actually has references to nonprofit in it. The reason why I say it that way is because, and we audit a lot of nonprofits, we hear of certain nonprofits getting crypto donated to them. So you're going to want to check this guidance that came out. It's pretty good, and we've been talking about this for a while now, so you shouldn't be surprised with some of it. But it applies to assets meeting the following criteria. Meet the definition of an intangible asset as defined in the codification. Do not provide the asset holder with enforceable rights or claims on underlying goods or services of other assets. They're created and reside on a distributed ledger based on blockchain or similar technology. They're secured through cryptography. They're fungible and are not created or issued by the reporting entity or its related parties. Okay? All right, sounds good. Now here's the accounting requirements. An entity is required to subsequently measure the assets that meet these criteria at fair value with changes recognized in net income in each reporting period. Which is a good change because in the past it was only carried at cost and or carrying value, and if impaired, could not be brought back up. Require an entity present one, crypto assets measured at fair value separately from other intangible assets, and the changes from the remeasurement of the crypto assets separately from other carrying amounts of other intangibles on the income statement. So they really want this broken out and separately and very clear. Require specific presentation of cash receipts arising from crypto assets, and then there's disclosures. That was just the accounting. Then we have the disclosures. The name, cost basis, fair value, and number of units for each significant crypto asset holding, and the aggregate fair values and cost basis of the crypto asset holdings that are not individually significant. For crypto assets that are subject to contractual sale restrictions, the face value of those crypto assets, the nature and remaining and duration of the restrictions, keeps going. A roll forward in the aggregate of the activity in the reporting period for crypto asset holdings. For any dispositions of crypto assets in the reporting period, the difference between the disposal price and the cost basis and the description of the activities that resulted in the disposition. Well, we're still not done. If gains and losses are not presented separately, presented separately, the income statement line item in which those gains or losses are recognized. And finally, the method for determining the cost basis for the crypto assets. Whew. So it's a lot. You see that if you are getting crypto assets, if you're buying, investing, receiving in some way crypto assets, there's a lot that's going to be required here. Especially this can be a big hit on nonprofits because if they get a crypto asset donated to them and they continue to carry it too. If they get it and immediately convert it to cash, there is a discussion about that and how it should be treated on the cash flows. This is effective for fiscal years beginning after December 15, 2024. So maybe not this Jan 1 for calendar years, but next January it's going to be effective. Now, I don't know if you recall, probably back in mid of 2023, Frank and I did an Issues Watch where we talked about the taxonomy of digital assets. The AICPA really came out with a nice presentation on the taxonomy of digital assets. I recommend if you get a chance, get a hold of that, go through, because it really explained a lot of this. And remember, one of the requirements is that they have to be fungible. And there's a lot of talk about non-fungible assets. Now, I'm going to be honest, I don't invest in this stuff. I don't follow a lot of this stuff, but you have people like Sean Stein-Smith who are really knowledgeable about this. You can look into this. You'll find some seminars through the society that really can bring you up to speed on some of the other stuff. Okay, this next one I've tried to summarize as best possible. Income taxes. ASU 2023-09, improvements on income tax disclosures. So I broke it out into the different categories that they address: rate reconciliation, income taxes paid, and then other. Okay? For rate reconciliation, first, public only. Those are public companies only. Now, I used to audit a lot of broker-dealers. They would still fall into this public companies, even though they didn't issue stock. You have to disclose in tabular reconciliation using both percents and reporting currency amounts for various categories. You know, the reconciliation of the statutory rate to effective rate, or opposite way around, either way. And there's a lot of categories that they address. I said I tried to summarize it because I only have 10 minutes in total, and I tried to summarize as best possible. You get this guidance that just came out, and you'll see the list of what they go through. Separate disclosure is required for certain reconciling items in which the effect of reconciling items is equal to or greater than 5% of the amount computed by multiplying the income or loss from continuing operations before income taxes by the applicable statutory rate. Whew. Reconciling items should break out between state and local. Now it's getting really, really granular. They want information disaggregated as much as possible. You're going to see even more. So continue on this, broken out between state and local. Those that make up greater than 50% for the state and local, foreign and federal. So they want these reconciling items broken out between state and local, foreign and federal. That's a lot. Reconciliation is generally presented on a gross basis. So for those that are in public, you want to look into this and see what's required. And those that are not in public, don't just turn off yet. Other than public, qualitative disclosure about specific categories of reconciling items that result in significant differences between the statutory rate and effective rate. Now, this has been out there for a while. A lot of people don't do it. Well, a lot of people have LLCs and S-corps that don't have significant tax. But if you do have a company that has income taxes that you have disclosure for, and there's a significant difference between the effective rate and the statutory rate, for non-public companies, you should at least have some qualitative disclosure. Not should have. You're required to have some sort of qualitative disclosure. Income taxes paid. Income taxes paid net of refunds disaggregated between federal, state, and foreign. You remember on the statement of cash flow, we used to just say income taxes paid, and we had no idea if we were supposed to net it with refunds. We don't have no idea what the heck it was for. It was the reason why it was on the non-direct method on the bottom was because on the direct method it was broken out up top. But either way, now it has to be disaggregated between federal, state, and foreign. Income taxes paid disaggregated by individual jurisdictions, which is equal to or greater than 5% of total income taxes paid. So if you file in 15 different states, you may have to break out the different state tax payments. And remember, these are disclosures. Other areas. Now, that income taxes paid were for all entities. Other area, all entities. I found this one really, really interesting. Income or loss from continuing operations before taxes disaggregated between domestic and foreign. Interesting. So this is income tax disclosure, and now they're saying on the income before from continuing operations before taxes has to be disaggregated between domestic and foreign. Now I have clients that are U.S.-based companies, and they have a lot of subsidiaries, you know, that are in different countries. I'm going to now have to break out and disclose the income between domestic and foreign. And then if we have taxes, I'm going to have some disclosures that relate to that, even though these are private companies. Income tax expense from continuing operations disaggregated between federal, state, and foreign. Now, if you pick up the guidance and you read through it, go to FASB.org, looking for the the accounting standards that are issued. If you go through this, you're going to notice when they keep saying federal, they refer to it as national, okay? It literally says federal, parens, national. And then they talk about the state and local too, and they're starting to use different nomenclature. So this is important for public companies for periods beginning after December 15, 2024. Same as the crypto. For other than public is for periods beginning after December 15, 2025. So we have a little bit more time for those that are not in public. But you see, this is coming up pretty quick. I'm surprised how quick this came out, but I guess they figure, you know what? This isn't 606, this isn't 842, this isn't CECL where they gave us a really long runway, especially with COVID. They put these out and they're pretty much expecting them to be implemented fairly quickly. So those are the two that I wanted to just bring to you that just came out right at the end of last year. In closing, I'd like to highlight some upcoming A&A events presented by the NJCPA Learning Partners. Common findings in single audits in 1-hour webinar being offered on January 15th, February 1st, and additional dates. There's a 1-hour webinar, Staying Sassy, a look at the recent accounting standards on January 16th and many additional dates. There's a 2-hour Keeping Up with the FASB webinar on January 18th, February 19th, and additional dates. And there are many more, too many to list. Search for events and register at njcpa.org/events. Lastly, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.